Thanks, Jandy. I thought what I'd do is spend a little bit of time talking about the two cases that I think has led to our current national companies and securities legislation. Whilst both cases have implications or have had implications for large public companies, certainly the Centro case has had and will continue to have implications for private companies and not-for-profits as well. So I wanted to start with what is known as the Poseidon Bubble. The Poseidon Bubble happened or started in September 1969 when a promising nickel find was announced by the principals of Poseidon No Liability Company. They'd found, or they'd reported they'd found a very promising and valuable nickel deposit in the Kimberley. And at the moment, at that stage, Western Australia was facing a rather significant mining boom. You might recall, those of you who are old enough, that Lang Hancock was big in iron ore, and Western Australia was starting to boom. The other two little implications at the time was the fact that demand for nickel was up. Nickel, unfortunately, is part of used in weapons, and the Vietnam War was in full flight, and there was industrial problems in Canada, which was the world's largest provider. So the month that it was announced that this nickel find had been identified, the share price was 80 cents. By the 1st of October, it had risen to $12.30. Now that's 15 times in a month, 15 times the value. However, it peaked in about February 1970 at about $280 a share. Now, just think about that for a second. $280 per share in 1970. The average wage then was $110 per week. A glass of beer cost 15 cents. And a packet of Marlboro Red 20s cost 39 cents. Now, don't ask me how I know the last two, but just take my word for it. So you've got a huge, if you like, a huge excess of value. And when you think of nickel mining, it takes years for a mine to come into production. So it just seems very funny that something would be worth that much. It was a form of share mania. Bit like Pass the Parcel, a bit like the South Sea bubble and the Tulip Mania bubble of the 17th century. As you might imagine, the share price reached its peak and then it dived. It turns out the find wasn't as good as initially reported. It also transpired that the industrial action in Canada was solved, and basically Poseidon disappeared away to nothing. And of course, it wasn't so much the large industrial industry share owners who lost out, it was the mums and dads. And there was the Ray Committee was formed by the then McMahon government. It took 4 years to come up with its proposals under the Whitlam government, but it led to much tighter regulation of the stock market, and also it led to the formation of the Australian National Companies and Securities legislation, and then ultimately the Commission. Prior to 1974, it was much easier to manipulate the share price by making some positive announcement, and then there were no real ramifications if it didn't work out. After then, there was what they termed the continuous disclosure rule, which meant if you were going to make a positive announcement about anything that's going to impact on the share price, actually up or down, you were required to disclose it, and you'd better be accurate in what you're saying. Now, subsequent legislation has made it much, much more difficult to asset strip as well. I think back in the day, there was a tendency for, I suppose, dishonest individuals to asset strip a company and then declare bankruptcy. And there's no definition of fraud in the Crimes Act, so it was often hard to detect fraud or prove fraud, but what they could do was they could predict, or they could identify trading when insolvent. And I think that was one of the main reasons why trading while insolvent is such a, an important thing these days. Important not to do, in fact. The Centro properties case is slightly different, but Centro was a company that owned and managed large shopping complexes around Australia with a combined worth of about $6 billion. Now, included in the audited accounts of the company for 2006-7 was around $1.5 billion of liabilities that were classified as non-current. Now, non-current, as I'm sure most of you, if not all you would know, is something that doesn't have to be paid within 12 months. In fact, and it wasn't just a simple error, it was a definition problem, but the money, the $1.5 million, actually had to be paid within a few months. Now, the disclosure about this coincided with the 2008 stock market downturn and credit squeeze. And so Centro found it very difficult to refinance. In fact, the share value of Centro fell from $10 in May 2007 to 3.7 cents in June 2011, sorry. So on paper, $36 million would have purchased Centro in June 2011. In October 2009, ASIC commenced action against six executive directors and the former CEO and CFO in the federal court for breach of care and diligence under the Corporations Act. Now, the directors' defence was that they relied on the advice of both management and the external auditors, who were PricewaterhouseCoopers, who had signed off on the accounts, and therefore, why were they in trouble when such august people had signed off? Nevertheless, Justice Middleton found against the directors, and he found that the directors had allowed the company to trade while insolvent, and of course, perhaps I'll jump forward a bit. The ultimate thing was that they weren't penalised just because they acted in good faith. But what it did do then was it opened up the directors to claims from disgruntled investors. So there was class actions taken, and that cost the directors quite dearly. So I won't quote too much of this, but under the Corporations Act, a person is solvent if and only if the person is able to pay all the person's debts as and when they become due and payable. And Middleton, in his judgment, said Australia's insolvency laws do not take account of an insolvent company's longer-term prospects, its competitiveness, assets or brand value. It does not allow for the possibility that through some restructuring or assistance, the company could return to profitability and preserve the interest of creditors. So basically, what this means is a company director can be held accountable for what the company has done, even though external experts have given the accounts a bit of a tick off. Pardon me. So while it does impact primarily on publicly listed companies, you can't rely solely on the advice and expertise of others, and having a positive cash flow is absolutely vital. I think some company directors, certainly the AICD, think it was a rather harsh judgment, but nevertheless, that is the judgment. And as a result, I think directors generally have had to give a lot more consideration and pause a bit when looking at what they're signing off on. The next little area I want to talk about was must-haves for directors. And this is just, this is a fairly basic sort of list, but hopefully there's something here that that might strike a chord. I think the most important thing a director can have is an inquiring mind and a preparedness to ask questions. And I think we all, as directors, occasionally are thankful when someone asks a silly question that you would have liked to have asked, but were too ashamed or too scared to ask because you should have known about it in the first place. The second thing is a director needs to have a really good understanding of the business and what it does. He or she needs to have a familiarity with the financial and cash status of the company. He or she needs an understanding of the financial statements, the documentation you get as part of the regular financial board meeting, and also the annual accounts. The other thing I think is a nose for trouble and areas of weakness and vulnerability. Now, it isn't always easy to have that capacity, but I think if directors don't accept things at face value, they should, and there is a concern, they should be quite free to probe. I think, as Justice Middleton pointed out in his judgment, directors are required to make decisions. They're not just there to give advice, they're there to make decisions. It's not the CEO or the Chief Finance Officer's role to make decisions. They are there to make recommendations. I think a director needs to have the ability to undertake regular environmental scans. And what I mean by that is, I'll give you an example. In my last full-time job with Villa Maria Catholic Homes, we had one director who was very good at looking at the competition. And he was retired. He was able to drive around Melbourne looking at where new aged care facilities, new retirement villages were being built. He got hold of the ACAR round outcomes and could see who got new bed licences. And as a result, he was able to feed in some very, very good information that enabled us to perhaps put a bit more money into advertising in those areas that were going to face competition or were actually facing competition. And I think another must-have, if you're a director of a public health service, particularly a large one, you'd like to think that there is a letter of comfort from the department, because most hospitals, not so much the smaller ones, most of the larger ones face a cash deficit at the end of each year. And actually the letter of comfort basically says the department will indemnify the hospital in the event that, that things go belly up. Now, as to what a director needs, the minimum information that a director requires so he or she is able to make a decision. I think there are a number of documents, and this is by no means all inclusive, but this is what I want if I was, the absolute minimum I'd want if I was a director of a company. I think you need an annual budget, projected cash flow, and the assumptions that go to make that budget and cash flow. I'm an independent member of a small hospital where we have a weekend place, and last month members of that committee were invited to a presentation where the CEO and the CFO presented the initial draft budget for the coming year, and things like what they anticipated the CPI was going to be, what they anticipated, what the wage rises or EBAs were going to be. That sort of stuff was put up, and it's a very good, I think, thing to have, rather than just having a director have placed in front of him or her a final budget. I think you need to be able to, well, it's much better if the director can see on what basis the building blocks are made for that budget. So you need an annualised budget and projected cash flow for the year. You need, obviously, an income and expenditure statement by reporting period compared to the budget, and you need a projected cash flow compared to actual. Now, I don't want to harbour the cash flow side of things, but I do think cash flow in many cases is more important than the profit and loss, because cash flow can bring you undone. I can recall when I was a young, freshly minted accountant doing tax returns, I had a mechanic who was a client, and he was a specialised mechanic in rural Victoria. He was the only one in his area of the state for many years, and as a result he made $200,000 back in the early 1970s per annum, which was a lot of money. And every year I'd have this little fight with him because he'd say, there's no way I've made $200,000, where is it? And of course, it was on his front lawn. It was his new boat and his new jet ski and his new caravan and new four-wheel drive. And that is the thing that hospitals and basically any institution has to be wary of, committing too much into assets that you cannot get rid of and convert to cash in a short period of time. Now, as far as exceptions, if there is, hopefully the budget has been put together to take into account all the timings, when the public holidays are, when the main expenditure items are due for payment, rather than just divide by 12 as it used to be done 40 odd years ago. It is very time sensitive, the budget, and when there is a difference, whether it be 5% or 2%, that needs to be highlighted and explained. And when I say maybe 5% or 2%, it takes several years to get a budget together. I think a lot of work was required to get a very accurate budget. So initially you might say, well, 5% variances need to be reported up, maybe by traffic lights. And as the budget becomes more and more refined and settled, perhaps 2%. You need a balance sheet, obviously, every reporting period, whether that be every month or every quarter, and the relevant KPIs. So when I say relevant KPIs, there's a whole string of these that you might want. The end of the year, end of the month, cash balance, the creditors' days outstanding, the percentage occupancy or days cash available, current liability ratio, equity ratio, FTE numbers, a percentage of sick and carers leave taken, that sort of stuff. And you need the budget forecast as well as the budget itself. The budget forecast, the budget's a budget. Once a budget's set, that's it. It should be set in stone for the year. The budget forecast is to take into account those factors that have occurred during the year that mightn't have been taken into account or you didn't know about. And a classic example 3 or 4 years ago was when the government decided to stop paying the dementia supplement mid-year for residential aged care. And in some cases, certainly in the case of the organisation I was working with, that was hundreds of thousands of dollars off the potential bottom line, and that will be shown in the budget forecast. And the last thing that I think it's important to have is the sensitivity analysis. So occasionally you might want to look at what might happen, for example, if occupancy in a large residential aged care facility or whatever fell by a certain percentage, or whether some of your clients, some of your community clients, if you're providing community care, were to take the money and go elsewhere. So you would factor in the sensitivity analysis, you'd factor in what you thought might happen into the sensitivity analysis, and you would see what impact it would have on the bottom line. All right, what else should directors require? Well, I think you need an internal audit program, and that should be, in my view, provided by an external provider. Some places employ their own internal auditor. I think there's inherent dangers with that approach, because the internal auditor goes to morning tea with staff and socialises with staff. I think you need someone who's arm's length to do the internal audit function. It's interesting. Some people regard internal audit as a waste of time, and I've changed my mind over the years. I think when I was first a CEO, I thought it was, but when you think of the external auditor's function, some people would say that as long as the amount in the profit and loss was shown, they would tick off on amount embezzled by CEO, for example. It is the internal auditor that will pick up the vulnerabilities and also pick up where there are problems. So you need an internal audit program, you need an independent audit committee. You can't have a finance and audit committee because that's like correcting your own homework. You might have it as an audit and risk compliance committee that also includes clinical matters. It depends on the size of the organisation. Smaller organisations, I think, can get away with that. Larger ones probably can't. I think it helps to have an independent or external member on both the Finance and Audit Committee. That's someone who's not a director, not a staff member, perhaps has got independent expertise to come on and cast a third eye over things. And I think there needs to be a crossover between the two committees. So you've got a director or one director who is on the Finance Committee is also on the Audit Committee, and that gives a bit of continuity. I'm a bit hot on agendas and reports going out to directors at least a week before the meeting, because as a director myself, I find that I often read the agenda over the weekend, and most organisations probably do comply with that. Over the period I've been associated with about 15 boards, I think, in either a employee or as a director, and not all of them, I have to say, managed to get the information to directors a week before the meeting in question. I think, as a director, directors should be able to insist on that. The other thing is late items for the agenda, and there's nothing worse than rolling up to a meeting and then have someone present to you a paper that requires a decision immediately. You haven't got time to absorb it. I know occasionally these sort of things do occur. When they do occur, it should only be in extremely urgent cases. If it's at a finance committee and it requires a recommendation to go to the board, I'd suggest it just go to the board and let the board in its totality make the decision. You need to have directors only meetings with both the internal and external auditors, and I'm sure most do that, and no information overload. It's interesting, one of the Centro directors, not complaints, but one of their explanations was that there was that much information that they were required to read. How could they possibly get through it? And Justice Middleton had no sympathy with that view. He said it was up to the directors to decide how much or how little information they received. I think what happens sometimes is directors say, well, we need this report, and they get that report, but nothing drops off. And in the end, you got a bunch of reports, yay thick, most of which don't get much attention at all. I think at the start of a board meeting, it would be reasonable to have at every meeting a question shown on the agenda. Has there been any issues of concern since the last board meeting that the board should know about? Now that can be a clinical matter, a financial matter, a political matter. It's just a way of ensuring the board gets to hear about any issue that the executive think is warranted of a concern. Now, a good director, again, you would, I'm sure most of you would know all about this, but a good director would understand their legal obligations as director under the Corporations Act 2001. Now, these are motherhood things, but it's worth knowing. Under the Corporations Act, you are required to act in good faith and in the best interest of the company. You are required to exercise care and diligence. You are required to avoid conflicts of interest, and you are required to prevent the company from trading insolvent. It doesn't say make a profit, but from trading insolvent. As a good director, you need to be familiar with the business. You need to have an inquiring mind, as I said before. You need to ask open questions. You need to know the areas of vulnerability and also materiality. When I first started as a director of finance 30 years ago, I was with what was then quite a large residential aged care provider, had about 1,000 beds at the time, had turnover of about 40 million, and we conducted a small kiosk on the side. So the kiosk turned over about $200,000 a year. And inevitably, at the finance meeting, I'd be asked more questions about why is the cost of sales down, or whatever, why is the stock down in the kiosk, more questions about that than I would be asked about the $40 million organisation. And I suppose that is because people at that time were from the business world, basically, and they understood sales and cost of sales and all that sort of stuff. But as far as materiality went, it didn't have much. It didn't have much impact, I didn't think. You need to understand the importance of cash flow, obviously. I think I've said that a number of times. Ideally, a director has completed the AICD course. And I was talking to someone about this just before. It's an expensive course, and I think boards should be encouraging those directors that haven't done the course to do it by paying for them to do it. It's you do a 5-day. We can do it over a period of time, but I recommend doing the 5 days. You do a 3,000-word assignment, and then you do a 3-hour examination. Once someone does the AICD course, they come back very much concerned, because it doesn't hold back. The course actually alerts you to the possibility that you might lose your house in some circumstances. So when as a CEO, you've got to be prepared to be asked more questions, and as a director, you've got to be a little bit, you've got to be aware that you might be a little bit put off by what you learn on the course. But it's a very good course, and I think all directors need to do it. The last thing a good director does is he or she maintains a professional but arm's length relationship with staff. Now, a bad director accepts at face value what they're told. They rely upon the knowledge and input of others. They attempt to trip up staff or display superior knowledge. And in fact, we're asked loaded questions. Probably the most skilled board I've ever been associated with had a really high-powered lawyer on it. And the lawyer would, after the finance report had been given and questions asked, the chair would say any more questions, and the lawyer would then ask a series of questions, a bit like the way a criminal barrister would, leading along the director of finance, and the poor director of finance was sitting there like a rabbit in the spotlight. And the last question would be, well, you say that, well, on the 27th of October last year, you said this, and it's sort of a gotcha. And really, to me, that was not just a waste of time. It actually inhibited discussion. It inhibited staff wanting to attend board meetings to explain what was going on in their program, because they felt they were under attack. So you really need, if a director's doing that sort of stuff, they have to be stopped. Obviously, you want a director to have read the agenda. You don't want them to roll into the boardroom and not having read it. And I have known that to happen. Back in the paper-based days, there was a director that I knew who would come into the board meeting and he'd open the agenda or open the envelope for the meeting as he sat down. There are directors who focus on the irrelevant, spelling mistakes. Mr. Chair, is that how you spell deficit? That sort of stuff. It's a total waste of time and effort. A bad director demands additional information to avoid having to make a decision. It's always easy to put off and require more and require more and require more information for fear of getting the wrong decision. And a bad director plays golf with the CEO or socialises with the CEO or the CFO. I think that's not a good thing at all. I think you can be friendly, you can be professional, but you should not be social with a staff member or a director if you're a staff member. And just finally, and this applies to directors and executives, I think you need to be aware of potential and actual conflicts of interest, and having that as an agenda item at the start of a board meeting as well. Is there any potential or actual conflict of interest that any director would like to know about? Or sorry, would like to report that we should know about? There needs to be a gifts and benefits policy and a gifts and benefits register. And years ago, when I was first a CEO, I'd be invited to go to a golf day or go to the football or the cricket, and I used to take up that option. But there's no such thing as a free lunch. And when I got to Shepparton and afterwards, I always knocked them back. Politely, I knocked them back. And there needs to, I think the register needs to record all gifts and benefits. And I say that because at one place we had a limit of $50, and someone received a nice bottle of red wine that retailed for $100, and they didn't record it. And the explanation was, well, I don't like red wine, and it's only worth about $10 to me, which may or may not be true. I think the other thing you can do with the gifts that sometimes pour in at Christmas time is pool them and use them at or consume them at the annual Christmas party. Not too much alcohol, obviously, or number them. And if you've got a small enough organisation, everyone gets a number and they get to take one of the gifts that's donated. I think obviously Christmas time, some people will drop in a cake or something for the ward. That's quite acceptable. But individual gifts and benefits, no matter what the value, I think need to be recorded. And in fact, I think it needs to be discouraged to some extent, the acceptance thereof. There obviously has to be a whistleblower policy and procedure, and it should include the CEO. So obviously, if someone wants to complain about the CEO, they should be free to do so. There should be a vehicle, which is normally through the board chair, for that to happen. There needs to be a board and executive code of conduct policy. Now, most government agencies have that. In fact, I think in public health, there was one promulgated in September 2016. There needs to be a code of conduct which sets out the expectation of directors and staff or senior staff, and there are various things that can go in that, but it's just so there's no, there is clarity, so people know that you're not allowed to do this, you're not allowed to do that. Anyway, I'll leave it at that. I think directors need, and senior staff need to promote a culture of honesty, and that means by setting the example, obviously, and that means not taking home sandwiches from the boardroom after the meeting. It's really, I think as a CEO, I could have probably survived taking the hospital into a $1 million deficit situation much easier than if I had have pinched a bottle of wine from the boardroom. People understand the latter. With the $1 million deficit, you always blame government for that. You should, if you do it, others will follow suit. There's no doubt about it. You have to promote that culture and lead by example. If you're in any doubt as a director, you should seek external advice regarding the current accounting standards and financial reporting requirements. And look, they change all the time. It is impossible, I think, for one person to know or be up to date with the accounting standards. Much better to engage someone financially, pay them some money to find out if you've got any concerns. It's sometimes said that the board is to do with strategy and the executive is to do with operational and management matters. And that is true in general, but I think, and again, I didn't think this way when I was just a CEO, I have to confess. But I think it's reasonable that if a director has a concern, it doesn't matter whether it's seen as a management matter. If he or she has a concern, they should go to the board chair and they should seek for that matter to be investigated. That doesn't mean that they should, take it on themselves to go and investigate a matter, but they should insist on it being investigated. There is no such thing as that is a management matter if there's a serious concern that is out there or rumours that something is out there. And just before I conclude, if you're wanting some sort of reality check or feeling really smart, you might think about undertaking the ASIC 10 question quiz on the ASIC website. That will be a real, well, it mightn't be a test at all to you, but it was a test to me. Naturally, I got them all right first time, as you'd expect. Perhaps I didn't, but it's worth visiting to have a look at the quiz and see how you go. And just remember, the board has a decision-making rather than an advisory role, and the days of it being otherwise have long passed. Anyway, that's the presentation. I'm happy to take any questions or comment.
So Greg, we've got a couple of questions. I might quickly just answer the first one, which is whether or not we'll be providing the webinar slides after the webinar. So yes, we've been recording the webinar, and we will let everybody know via email when the webinar is available.
Yeah. And Andrew Donovan's asked about financial literacy, the minimum standard that that the courts require of directors. I think it'd be fair to say the AICD course provides a reasonable. Well, you have to do a segment that's to do with finance, and I think that would be reasonable to suggest as a minimum requirement. And it's if you're an accountant, you're expected to have a minimum standard of financial literacy. I haven't worked as a finance director for 30 years. I don't know whether I actually would these days. I know what I require, but if you ask me about a standard, I don't think I'd be able to answer too fluently. So I reckon basically if you've done the AICD course, you can hold your hand up and suggest that, yes, I've got a minimum standard of financial literacy.
Okay, we've just got a subsequent question from Andrew there.
Ooh. Well, I think you need to be able to read the profit and loss statement and a balance sheet, and you've got to be able to look at the cash flow and how it's going. I think if there's anything that is outside the norm in the cash flow, is anything that's likely to hold up the payment of creditors, I think that needs to be drawn out. It's interesting with the Centro case to speculate on what would have happened if the 2008 credit crunch hadn't have come along. I suspect nothing. I suspect the company would have gone to the financial institution they borrowed the money from. It would have been rolled over and nothing would have been heard. I might be wrong, but certainly cash becomes an issue when cash is tight. It doesn't mean you have to have the cash in the bank. You can go to the bank and get a loan, but being able to pay your creditors as and when they fall due is vital. Anonymous attendee asked, do you have a link for the quiz? I think if you go on the ASIC website and just put in ASIC 10 question quiz, you'll get there. I was a bit embarrassed when I actually did it, but I've subsequently learned, I think.
Great, and it doesn't look like we've got any more questions, so we might wrap up for today. So just wanted to say a special thank you to Greg for his invaluable insights, not only into the financial responsibilities of directors, but also the holistic expectations of directors on boards. As mentioned previously, we have recorded the webinar and we will send you an email when that's available, both on the Governance Evaluator and Vimeo. And I'd like to thank you for all attending today and wish you all a good day.